March 2nd, 2022, investor update. Our top selling advisories up 13.5% total return in 2022. Most investors are getting slaughtered, down 10% or even worse. Our high risk growth portfolio returned 233% in 2021. That means every $10,000 invested turned into $33,000. And this is an emergency investor warning. There's a lot of problems developing. The big one is NATO goes nuclear on Russia, imposing the SWIFT ban on their central bank. This is the big move that we didn't think was going to occur. The world is now afraid to buy Russian oil. Something like 70% of their oil is not being purchased because purchasers are worried of sanctions. This is causing skyrocketing costs that may crash the global economy if they don't go down very soon. We're looking at a huge trade alert to short the price of oil. Almost every outcome, good or bad, leads to crashing energy prices once these potentially even shoot up even higher. The Russian currency is now collapsing, down 55%. So they are now facing hyperinflation in Russia. The Russian stock market has imploded 50% in the past 5 days. Okay, so it's trading at $8. That's the lowest it's ever been on the charts with RSX. This is equal to what we did after World War I to Germany. And it ended up collapsing the European economy completely because Germans just couldn't afford to pay back war reparations. So this is not good what's happening. If we don't get peace talks, watch for chaos to ensue. There's new peace talks this Thursday, but it looks like Russia and NATO, for that matter, are preparing for the long game and go no further than Biden's State of the Union address. The first 20 minutes were all about pro-war and protecting democracy in Ukraine. But we all know Ukraine is one of the biggest corrupt countries in the world, and it's been a hideout for US to sneak money out and pay off people. So this is just a mind-boggling disaster that's unfolding. But yeah, it looks like Russia's pretty much just going to suffocate the capital of Ukraine until it surrenders. Russia may soon cut off natural gas to Europe, or Europe could even cut off natural gas to itself at this rate. And meanwhile, I expect Russia to start bringing in heavy and heavier military to begin destroying Ukrainian targets. So this is escalating. We've got a period of peace tomorrow, but we will see. It's time to protect your wealth. You need to buy this simple 3-stock portfolio now. And here's our current trade alert recommendation for a $10,000 investment. So again, if you had $20,000, double it. If you had $100,000, increase by 10. What's important is to have the ratio of shares. And if you're on a free trial, call Dean. He will screenshot that for an exact dollar amount. If you're a paid member, log into the membership area, punch in your investment total in the software, and it will tell you this. But here's the breakdown on $10,000 right now. Step 1, buy 79 shares of UVXY. This delivered a 1,100% return in a month when we locked down the global economy and actually sent oil prices negative. Can you believe that? 2 years ago, we were looking at negative oil prices. Today, it's over 110. Now, since we've been long the VIX this year, it's already up 57% year to date. Now, I know a lot of you guys have been holding that from much higher prices, but its job is to protect the long side of our portfolio. It's not there to make us rich. So we're actually expecting, hopefully, to see a de-escalation, dump our VIX for a big profit in the short term, and dump it into our favorite growth asset. But it's just way too early to believe the problems are over yet. The spot we see the biggest gains with the least risk over the next decade, and specifically over the next 12 months, is with ETHE, an OTC stock, which is the Grayscale Trust. They're trying to convert to an ETF. This gives you exposure to a cryptocurrency called Ethereum. It has some major advantages over Bitcoin. and it's our favorite growth asset. We consider it a technology company that you're getting into in the first decade. Imagine getting into Amazon in its first 10 years of being around, or Apple for that matter. Massive, massive returns to be had in Ethereum relative to any other large tech company. And what it's doing is replacing the entire financial system into a decentralized mechanism that cannot be stopped. It is remarkable, it's breathtaking, and it's growing rapidly. Hundreds of billions of dollars are now invested in this asset, and it's replaced everything from insurance to being able to get in and out of different cryptocurrencies to taking out loans, you name it. Not even to mention this NFT craze. And the returns speak for themselves. If you had gotten into Ethereum just 2018, you'd be sitting on a massive 15,240% gain right now today. Now we've had a huge sell off. I'm expecting this to break into new highs. Here's your exposure to it safely through your stock trading account with the Grayscale ETHE Trust. So ticker is ETHE. Step 3, buy 89 shares of BOIL. This is natural gas from US. If we start to sanction energy from Russia, or Russia cuts off Europe from its energy products, or pipelines start getting blown up, who knows? The main wild card ahead that's not already at all-time highs, we've already got wheat, palladium, oil, everything pretty much is already at all-time highs. The only asset that's not screamed to new highs yet is natural gas. The recent high we had without war was in the 90s on BOIL. Today it's at 41.56. This could easily double, triple, or quadruple if this escalation doesn't stop soon. Okay, so we call this the inflation hedge, the Russia hedge, the interest rate hedge. Your growth asset, which is Ethereum, does not like interest rates to go up too quickly. Okay, neither does the NASDAQ. So all of these positions are designed to allow you to have exposure to Ethereum over this decade and reduce volatility. So here's what we're hoping. Some sort of de-escalation occurs in the next 2 to 4 weeks. We're going to dump UVXY. We're going to dump BOIL. We're going to rotate into shorting oil with DRIP. And we're going to dramatically increase our positioning into Ethereum. We'll also be looking at the right time to go back long energy. And I have some very clever ideas of how to do that. But first, we need oil to fall. And it needs to fall a lot before we're going to get back into that. The only asset that really makes sense with the risk reward profile today to be long commodities is this BOIL play. And so that's looking better by the moment. We'll see how these peace talks look Thursday, but I expect nothing to occur in the short term. So there's probably a de-escalation in the cards soon, and I'm talking in the next 2 to 4 weeks. And if so, energy costs could sell off rapidly, causing bond yields to fall. And here's a look at that chart. And the oil price will do the trick itself. Prices too high will collapse the economy and create a crash in the price of oil, or a de-escalation will cause a crash in the price of oil. So one way or another, this oil price is going to fall, and it's going to fall rapidly. We're ready to position into the ticker DRIP at the right time. I wouldn't do it right now because I think we're about to escalate even further in the next week or two before a de-escalation occurs. So again, markets can remain irrational much longer than you can remain solvent. So be careful shorting oil too soon. But mark my words, a massive money-making opportunity is around the corner to go short oil. And here's a look at the bond market. This is the TLT. If it's going down, that means interest rates are rising. If it's going up, it means interest rates are falling. I'm a believer that interest rates for the next year or so are most likely going to stay flat or fall. And this is going to moonshot technology companies. Okay, and the only thing that's going to slow down this is going to be these energy and food costs, which are being disrupted from the war. So that could throw a wrench in the bond market soon if this is not de escalated. Now, falling bond yields most likely will moonshot cryptocurrencies and tech. So we like the NASDAQ and we like Ethereum as the two single best assets. Bitcoin is also in there as well. Now, we have two products, the safe growth strategy, where we put 70% of our capital, highly diversified portfolio, which includes Bitcoin, three major stock exchanges, and four different types of inflationary hedges. And then the one we're previewing today is our high risk strategy, which simplifies it into 3 to 4 positions. And it's great for newcomers who want to get a massive return with a very simple portfolio. The other big thing we need to pay attention to is there's a new credit expansion starting from China and soon from Europe. Okay, these disruptions are going to cause more money printing, more debt issuance out of Europe. And this is all during a US rate hike cycle starting in March. Now, it looks like rather than a 50 basis point hike in March, we're going to get a dovish surprise for 25 basis points. Powell was talking to Congress today and almost guaranteed that with his speech. So this should be good for bonds in the short term. But now, just in general, what should we expect if the US is going to go into a rate hike cycle over the next several years? Well, over the course of time, it generally punishes the bond market and tells investors to go anywhere else except bonds. And that's until those interest rates become super attractive. The last time the US tightened while China expanded credit, Bitcoin went up 4,400%. Okay, so right when Trump came into office, they started jacking up interest rates and then went into quantitative tightening later on. So just because that's occurring doesn't mean we want to jump off ship on our favorite assets. In fact, it's going to force investors right into our sweet spot. The big picture, though, is that the global economy is slowing down. Inflation may peak by March. Yeah, that's what I've been saying for months, but this problem with Russia could potentially extend it into perhaps a whole nother quarter. War with Russia could cause food, energy to keep the CPI high an extended 3 months. So we need to prepare for that potential outcome. But in the meanwhile, this is still putting investors in a tough spot. Cash is trash. Governments globally are spending more than they make. That makes the value of cash go down, no matter what currency you're in. Meanwhile, bonds are garbage when inflation is way over the interest rate. And there's really no signs the inflation is going to fall precipitously in the very, very short term to make us go extremely bullish on bonds. We're actually just looking for a short term pullback in yields and then further pain for bonds as the economy recovers. So this leaves investors with no other logical option. And that's why you see stocks flying up and down every other day. You can go to cash, but then you have nowhere else to go back to because you know cash is a losing position and you know that bonds are paying out a yield that's pathetic compared to inflation. So you got to go long stocks, cryptocurrencies, and commodities. Now, we believe the commodities are overplayed and we're about to have a pullback. And you're about to see cryptocurrencies and the NASDAQ skyrocket. So that's what we're looking in the short term in terms of how to position for what comes next. Now, if you're on that free trial, you get the trade alerts to get in, but you don't get the trade alerts to get out. So you need to watch our webinar every Monday, Wednesday, Friday for sell alerts, and you need to upgrade your free trial. There's only 3 spots available today at special pricing. If you call Dean right now, you can get that special deal, 505-322-7515. So call Dean, talk to him about your portfolio, get a customized screenshot, and take advantage of the special offer we have today at 505-322-7515. Okay, very good. So the portfolio that's really shining today is a high risk portfolio. If we look at the breakdown on returns, we did a 9.9% return in January. We lost 3.6 in February and we're up 8.4 in March. and this just jumped to 14.8 total return with a ridiculously simple 4 ETF portfolio. So that's what we're going to cover next. At the end of the webinar, we're going to cut off all the freebies and we're going to reveal our safe growth strategy, which is actually outperforming markets as well, and where we recommend putting 70% of your capital. Harry says, Jason, your selection of assets has been magic in these turbulent waters. Yeah, it's been wild. It's been a wild year. And I didn't think Putin was going to go beyond taking those 2 outside territories. So this was obviously planned with China, probably for well over a year. Let's go ahead and jump into the news feed. Okay, so we'll start off with the headlines, and then we will go into charts data, and then we'll go into asset allocation at the end. Okay, so here's a look at what happens when oil costs go too high, too fast. It causes recessions. Okay, so eventually consumers can't afford the prices, and you get a crash in the economy, a recession. So again, if we let oil go too high, it's going to crash. If we de-escalate, it's going to crash. Beautiful trade alert coming soon to short oil with the ticker DRIP. Don't do it yet, but we'll make that trade alert when it makes sense. U.S. Treasury Yellen says 80% of Russia's banking system assets now under restrictions. Half of Russian central bank assets were immobilized by Monday. This fellow was talking about how Starbucks coffee went from $4.78 to $5.21 in a day, just showing the massive inflationary pressures coming in currently. Oil's at the highest level since 2008. There's some unconfirmed documents saying Ukraine was supposed to be taken in 2 weeks. X-Trend says Fed caving, which they mean doesn't do a 50 basis point hike, does a 25. We get a run up in this S&P 500 in the short term, and then stagflation crosses the point of no return. So he's saying if we don't hike aggressively now, we're likely going to have a rally in the short term, and then you have the inflation crush the economy later on. And he says if the Fed hikes a lot now, we get a sell-off in the short term and then have a massive Goldilocks stock market rally into late 2023. So we'll see. That's just one person's analysis of it. And again, we're playing this week by week with how fast everything's changing. But I, in general, would agree with that, at least in a 3-month outlook. And we're going to have that meeting in less than, March 15th through the 18th. We're going to get the next FOMC, and I believe we get the next CPI next week. We'll talk about what we're expecting with both, what impact that will have on markets. But again, the big wild card is whether or not energy costs go skyrocketing up in the next 2 weeks or not due to Russia conflict. Meanwhile, U.S. Democrat Senator Manchin says a bipartisan bill to prohibit Russian oil imports is in the works. So that's why we don't want to short oil just yet, guys. China asked Russia to delay war until after the Olympics, according to the New York Times. Well, of course, these two are on. There's no way Russia would have done this without the full support of China. Of course. Today, the Biden administration is allowing the Russians to dominate the U.S. negotiations on the Iran deal in Vienna. I'm not an expert on that, so I'm not going to go into too much of it, but there's a big thread here. I'll just read a few highlights. Gabriel Norana says, my former career State Department, NSC, and EU colleagues are so concerned with the concessions being made by Rob Malley in Vienna that they've allowed me to publish some details of the coming detail in hopes that Congress will act to stop the capitulation. Okay, we'll skip through that. The end note is this could help relieve some pressure on oil and remove sanctions on Iran. Then we have 4 Russian fighter jets flying through Swedish airspace. This is probably more important than anything else as far as Fed policy is to watch the bond market. We had the junk bonds and the investment grade corporate bonds crashing all year. They're starting to get a bounce. So you can see that right here have hit a critical level. And that's probably, along with the government bonds, why we've had so much pain in equity markets over the last 3 months. Gary Kasparov, a chess champ, I don't know his political angle, but he's ready to go full-blown war against Russia. Putin's war on Ukraine has entered its next phase, one of destruction and slaughter of civilians. It is also a part of Putin's world war, war on the civilized world of international law, democracy, and any threat to his power, which he declared long ago. Copper's on the brink of a major breakout. If we go through this bullish pennant, prices will likely accelerate to the upside. And copper likes to go up when China's expanding credit. There's a massive melt up in crypto recently. However, was it from Russia or where is it coming from? So I have seen some data that there's a lot of rubles converting into Bitcoin on centralized exchanges. So I'm not too sure, but there's definitely been a melt up in crypto that's been mind-boggling and could just be the very start. Chai Girl, a energy expert, says Cushing crude inventories now sit at 22.8 million barrels, the lowest ever over the last 2 decades. Was 13 in 2007. So we're seeing that governments get ready to release some more of the strategic reserves. But should they wait till we get a some sort of resolution with Russia? Powell today at Congress says Ukraine crisis is a game changer for the Fed. In other words, they can slow down all this hawkish talk. So Russia says they've lost 500 troops and Ukraine says it's 7,000. So we'll just cut it in the middle, perhaps 3,500, probably 5 times that injured. We've heard through Yellen, through Powell, through Biden that they are not happy with crypto. It's unclear what they could do about it. Cryptocurrencies are a means to evade law enforcement, and that's something we should not tolerate. I've heard Janet Yellen say similar. Oil is 3 sigmas overbought. The last time it was this overbought was the Russian invasion of Crimea, 2014, which preceded a 75% decline. Germany's interest rates fell again and back into negative real rates relative to inflation. So we're getting all new 2020 lows in rates while they're having some of the highest prints on inflation, putting real rates to a new record. So it's inflation minus the interest rate, or vice versa, excuse me. It's the interest rate minus the inflation, which is making that negative. The MOVE index is like the VIX, but for bonds. And those bonds are screaming up and down and up and down every other day, which is causing, I've noticed, about a 2-day delay on the NASDAQ now. So if you see bonds crash, which, spoiler alert, they crashed today, TLT down 3.4%. Heads up, we might see some volatility incoming into cryptocurrencies and the NASDAQ in the short term. Russia will treat any hacking of its satellites as a justification for war, the head of the country's space agency was quoted as saying in a news report on Wednesday. Here's a collapse of Russian oil and gas sales, down 95% on the 4 majors. So what happens when that comes back online? Obviously, these prices go down, yields fall. Robin Brooks says the Eurozone and debt, the world is much riskier than we thought. COVID and war in Ukraine are big reminders. Markets will demand higher risk premia and yields, but higher yields are incompatible with high debt. no option but for the ECB to do quantitative easing. He's predicting the dollar will rise against the euro. The Federal Reserve's basically hoping, now this is really BS, but Goldman Sachs is predicting that we can get to about 3.5% CPI by the end of the year, and then slowly get down to 2.5% by the next year. We've got Fed Evans saying about 1% less. And what's important is that if they are not headed that direction, we're going to get some hawkish surprises with rate hikes. So that's a pretty big task to see these interest rates, or rather the CPI, get to that level by year's end. Right now, that's not looking to be the case unless we get a de-escalation. Powell is admitting the economy is at full employment. We had a big ADP number today, and they revised a negative number to be 500,000. These people creating the data for the U.S. government are a complete joke now. You cannot be trusted with any data because they revised it a month later to be completely different. Peter Schiff says Powell claimed that central bank government debt monetization doesn't cause inflation. He claimed inflation is caused by strong demand and supply shortages. Powell doesn't understand that printing money to buy government debt, which is then spent into circulation, increases demand. I think he does know that. Anonymous offers Russian soldiers 50,000 of Bitcoin for each surrendered tank. So we're in the fog of war. We've got to be very careful. Propaganda is going to be coming out of all sides. Mark Rubio is full blown, let's go to war. So pretty much the whole government wants to push for war, fund the military complex with record budgets. If Biden was serious about defunding Putin's war in Ukraine, he would have called for lowering oil prices and ensuring energy independence by reopening U.S. oil production and Keystone pipeline. So yeah, why aren't they doing that? That's a very important question. OPEC's not really increasing output much. Powell says there needs to be congressional action on cryptocurrencies. We're yet to see what they will do. Payroll ADP 475,000 in February versus 375,000 estimate. And they revised up last month to be 500,000 instead of minus 300,000. So just they've been doing this consistently. I think it's because they don't want bond yields to rise. They keep printing really bad numbers and revising them later. Essentially, the West took down Russian finances in one day. The situation is likely to become worse than in 1998 because now there's no positive end. All Russia's capital markets appear to be wiped out, and they're unlikely to return with anything less than profound reforms. We can see the Chicago PMI is falling, indicating the economy is slowing down, which would normally make rates fall. Capital performance during times of war, generally positive because you go into money printing after the scare. And probably the most important piece of news today, in one little bit, is Powell saying he's not inclined to hike 50 basis points in March. But if it stays hot, we could do it in a future meeting. That's the most important thing here. Okay, let's take a look at interest rates. So We got this sell-off in bonds, and then it reversed today. We have this massive rising 2-year, and this is putting pressure to go to 50 basis points right away. So that 2-year is just unrelenting. This is what drives the federal funds rate, and it's way, way, way behind. Okay, so to catch up right now, it would have to be the equivalent of 6 rate hikes in one meeting. So they're way behind the curve, and the 2 years demanding they need to raise interest rates. A minute ago, yesterday, this was at a 6% probability. It's back to a 95% probability to hit a 25 to 50 basis point rate hike. The reverse repos remains elevated at 1.5 trillion. We call that the QE buffer. Here's a look at BOIL and NRGU, our two energy plays we like. We got that massive jump back in February, and then it crashed, and now it's regained about a third of that run up, and the fireworks could be coming soon. So let's see what happens on Thursday. But in general, it looks like energy is going to remain stickily high until we get a catalyst for a crash. And that could be one more big push higher in oil prices, causes a meltdown in markets. Now, we had gold telling us lower yields for much of this war period. Now we've got copper jumping up. So again, if copper is going up faster than gold, it predicts higher interest rates. Baltic Dry Index was a good indicator that the inflation was going to slow, but it has caught a bottom and has bounced. That's the cost of moving commodities to various continents. Here we have the NASDAQ, energy, and funny, we got rates rising with oil pulling back a little bit here, or at least the valuations of oil companies, the US oil companies. And we've got the NASDAQ going up. So very bizarre move in markets today. This chart, we're comparing interest rates in yellow, the spot oil in the candlestick, and then RSX, Russia. And they've been highly correlated until just recently. Now we've got yields falling back, oil staying up above, and we've got Russia down 74%. So some pretty alarming moves there. In this chart, we're comparing emerging markets to the NASDAQ. Emerging markets is where we moved a lot of capital in our safe growth strategy. And it's done its job by losing less than other markets. That's the asset I believe we're going to make the most money on in the next 5 to 10 years in terms of a big stock market. So that would be Asia. Most likely Asia and Europe could do very well as they expand credit while the US has to slow down credit and probably is going to have a divided government. That'll make it very hard to spend money, or gridlock, because I am expecting Republicans to take over at least one branch of government at the end of this year. So it looks like there just may not be any spending coming through at all this year beyond what's already approved. We'll see. Maybe some more defense spending, some bailout money for Ukraine. Russell 2000, after crashing out of a channel, is back into an uptrend and targeting a correlated relationship to rates in yellow. The European index took a little bit of a nosedive on all this chaos, but again, this is going to make us expect more QE coming in. The dollar's been going up, but nothing crazy. Our main outlook over the course of time is for the dollar to fall to 90 before a big bounce. And we'll be pretty resilient in how we're positioned until that happens. Chinese currency, only currency outperforming the dollar right here. You can see if it's going down, it's getting stronger. Let's see, we've got this massive jump in Tesla, Nvidia, as rates are rising. That's bizarre, but we did have this sell-off right here. So it's almost as if the NASDAQ's now trading somewhat delayed to interest rates. So with this big shock to the upside on rates, let's watch out to see if Tesla takes a nosedive. in about a 48 to 72-hour delay. That's what I'm starting to pick up on. Here we're looking at Berkshire Hathaway, Bank of America, and JP Morgan. With their relationship to interest rates, they should be trading correlated to rates, and they clearly are. In this chart, we're comparing Alibaba, Tencent, and Taiwan Semiconductors, seeing if China's really helping out their equity markets or not. And so we're looking for outperformance in Alibaba and Tencent. It started, and then we got this big dump in equities. And we can see Alibaba's way below Taiwan Semiconductors in terms of total return over the last year and a half. So we'd like to see big bids on Alibaba and Tencent. And that could be the signal to get even more aggressive in emerging markets. Toyota taking a nosedive, down 16%. It's been probably the best performing large cap stock in the European index we're invested in. Lots of disruptions to their ability to operate. Exxon trading at a 80 price level. To see it at a higher level, we got to go back to 2008 crash. So again, I in general think we're going to have a sell-off in oil, and then it goes higher in time with more stimulus. But so far, of course, the conflict with Russia is keeping oil prices at obscene levels and supporting this very high price on Exxon in the short term. This is the yield curve between the 2-year and 10-year, and it's good at predicting recessions about a year and a half out when it goes negative. It's been heading that direction for about 9 months with very little relent. So we'll look at that bond yield curve in a different format in a minute. Here's the 3 important bond markets. Now note, in 2021, we started off with a bond market crash over 3 months, and then bond yields fell for the remainder of the year. And you had a big return on the NASDAQ and crypto. We started this year off almost identical to what happened last year. Is the bottom in, and rates fall from here. That's my best guess as soon as we de-escalate with Russia. But that may not occur until that happens, because energy costs and food costs are a big problem currently. And with disrupting chips and autos, again, that was another part of the CPI. Plus we got wage pressure and rent pressure coming in. So this could make us have to recalculate the CPI data and thus the bond market. Okay, this is comparing ETHE to Tesla. These two have been trading very correlated. And this is showing us the potential for another big gap up in Ethereum, which we just had in the last few trading days. If we go back to October 10th, AGQ, a leveraged silver play, is up 29%, and gold's up 20%. So keeping a close eye on those. If I go to a monthly chart, people are hoping for a 2009 QE stagflation type of ordeal where silver went parabolic. So we'll keep a close eye on that and potentially get some exposure back to it. Here's the bond market. So boy, look at that. Bonds go way higher and then way lower just in the period of a few days. This is mind-boggling. Not good. Here's a look at some other plays in our safe growth strategy. We like REMX, rare earth metals. We like uranium for nuclear. We're not currently in copper miners. We look at these other two as a better bang for your buck, more cutting edge, and looking into the future of what global economies are going to need for energy. And that's lithium with REMX and cobalt, and then of course uranium for nuclear. Beautiful plays. Same setup, the rate shock crashed these, and then they had a massive rally the rest of the year, expecting the same. So these could be setting up for a huge run up, just like crypto. Here's Bitcoin during that, leading into rate hikes and through rate hikes. And funny, even during the runoff on the balance sheet, that's when it really went parabolic. So if you force the bond market to crash, investors have no choice. That's really the lesson here. But then the bonds went into a huge bull market after they stopped forcing bonds down. So this could be a great time for our strategy to shine. This can give you a feel for how bad the gold to copper ratio could get with high energy costs. And you can see that from 2002 to 2006 until it crushed the economy and the real estate market. All right, here's a look at the yield curve over the last 3 months. Orange is 2 months ago, green is 1 month ago, blue is current. We've got a very ugly flattening of the yield curve. It's inverted on the 20 and 30 year. The 2-year keeps going up, saying inflation's way too high, we need to hike rates. The long end is saying once you do that, you're going to crush the economy and send us into a recession. That's just not the shape they want. The last time we had a good yield curve was before we did a bunch of stimulus. Before Trump lost, he did a $1 trillion stimulus. Biden did 2 trillion. It was too much. So we went from a perfect yield curve here in October of 2022 to a totally messed up one. So that's what happens when you overstimulate and create too much inflation. The economy loves the 2 to 3% inflation. It does not like the 7%. Here's your VIX futures term structure. This is in backwardation, which means the VIX or UVXY is primed to skyrocket up or down. Okay, so this could get crushed and fall precipitously, and stocks would be skyrocketing up. Or if there's any more pain, it's going to outperform. So it's set up to really deliver some serious returns. So if you own it, you better own the rest of the portfolio. Okay, you don't want to just buy this on its own. It only makes sense if you buy the rest of the portfolio simultaneously. The only crypto I like even more than Ethereum or Bitcoin is a coin called Matic or Polygon. It's like the Lightning Network for Ethereum. So Lightning Network makes Bitcoin much more efficient. Polygon makes Ethereum much more efficient. And it's simply a super leveraged tech company with lots of growth ahead if you like that asset. It's not in any of our portfolio builder strategies. If you do upgrade to a paid member and ask Dean about our private equity offering, we can get you exposure to Polygon. You have to be an expert at cryptocurrencies to know how to trade that. All right, here's the core inflation. We're going to get a new print, I believe, next week. Let's hope it's below 6.5. If it's not, the bond market's likely going to be pissed off. I don't have a good idea of what it's going to print. And March is probably going to be even higher. So I'm expecting it to go higher until March. And then if we see energy crashing before, then I'd expect it to go down into April. And that would be perfect for how we're positioned. So very important to watch that data. PPI looks like it's topping out. The rate of change is slowing down. 3 months of flat. That's good for how we're positioned. There's this ridiculous non-farm payrolls that keeps getting changed. I wouldn't even read that data anymore. Labor force participation rates rising, which can create rising rates if it goes on too long. Bank credits growing and consumer credits going, which is good. If we saw either of those falling, that'd be bad news for stocks because the government's not stimulating as much. Meanwhile, the Fed's balance sheet is at $8.9 trillion, and tomorrow they'll update it. It'll probably break $9 trillion. ECB keeps growing its balance sheet. So that's the big picture and the primary driver of markets. But again, this could be coming to an end here. Or it is, actually. That's what we've been told. Okay, very good. So this is where, if you're a freebie, you're going to get cut off. You're not going to see the exact asset allocation strategy and what we see as the next big trade alert. So call Dean, upgrade at 505-322-7515.